When diversifying your stocks, you'd want to get the most value out of your assets. So generally, you'd want to have a good feel of what you're putting your money into. If you had three choices to choose from, whether it's something risky, something more secure, or something overseas, if you had the option to pick all three, then it'd be a pretty good thing to have. Dividing your attention and resources between all three, however, that's a different story. This is Intelligentsia, real-life advice for practical and financial goals. Today, we want to talk about the 3-fund portfolio, who can benefit from it, and why you should use it. So let's get to it. In your portfolio, you'd want to spread out your money into different asset classes in order to mitigate risk. While you can't avoid risk, you can at least reduce the type of risk that you can take based on the investments you make. If you want to make the most out of your investment, most people will go for the riskiest option, which is to put 100% of it into the stock market. But if you're gonna do that, you have to be comfortable with taking on a risk in order to make the most out of your investment, which is a problem if you don't know how to properly allocate your money into the right funds. That said, we first need to be able to know what funds we want in our portfolio to know the ratios. For that, the 3-fund portfolio is a simple and popular investment strategy that involves allocating investments across 3 main asset classes: domestic stocks, international stocks, and bonds. Breaking down the 3 asset classes, we have 1. Domestic stocks, total stock market fund. This fund invests in a broad range of domestic stocks, aiming to replicate the performance of the entire stock market or a major stock index like the S&P 500. It provides exposure to the US economy in various industries. For domestic stocks, the 2 most popular examples are the Vanguard Total Stock Market Index Fund Annual Shares, or the VTSAX, and the Vanguard 500 Index Fund Annual Shares, or the VFIAX, for the S&P 500 companies. VTSAX is the most comprehensive total market index and is comprised of 4,000 companies, while VFIAX is composed of the top 500 companies in the United States. One of the key components of the 3-fund portfolio is a good local index fund to represent the domestic stock portion of your portfolio. For the purposes of our video, we'd like to focus on the VTSAX for simplicity's sake. VTSAX aims to replicate the performance of the entire US stock market by tracking the CRSP US Total Market Index. This index includes a wide array of stocks, providing exposure to a variety of companies across various industries. Since you have access to a lot of different stocks, VTSAX inherently offers diversification within the US equity market. You're exposed to numerous companies across the United States, and as a result, you're spreading the risk associated in investing in individual stocks. Historically, the domestic stock market has shown long-term growth, with VTSAX delivering competitive returns over the years. VTSAX also offers low expense ratios. Since you're paying significantly less for annual payments and cost effectiveness, you're essentially saving out a lot in the long run for as little as 0.04%. Because it's also passively managed, it doesn't aim to beat the market, but instead tries to mirror it. This often leads to lower costs and lower taxes, which aligns with the strategy of the 3-fund portfolio of maximizing your gains despite effectively diluting your returns by diversification. If you're including VTSAX in your portfolio, you have the benefit of capturing the potential growth of the domestic market and the diversification of having access to more than 4,000 companies in the US stock market. That said, if you're satisfied with your domestic stock portion, you have to understand that putting all your investments into domestic stock assets is risky despite the great returns that come from it. For you to be able to mitigate the risk and have more security in your portfolio, you'll need to be able to invest in bonds too. Number 2. Bonds, or Total Bond Market Fund. This fund invests in a significant portfolio of bonds, including government, corporate, and municipal bonds. Most investors generally consider bonds as a more stable asset class compared to stocks, and they provide income through interest payments. In terms of the bond market, one of the most popular ones that you can go for is the Vanguard Total Bond Market Index Fund Annual Shares, or the VBTLX. The VBTLX aims to replicate the performance of the Bloomberg Barclays US Aggregate Float Adjusted Index. For this one, you're allowed broad exposure into the bond market, representing around 10,173 for US bonds. This index includes various types of bonds such as the US Treasury, government agency, investment-grade corporate, mortgage-backed, and asset-backed securities. Because bonds are considered less volatile than stocks, having them in your three-fund portfolio is a great way to mitigate risk. It provides stability and can be a counterbalance to the risk of the stock portion in the portfolio. One great thing to look forward to when you go with VBTLX is their low expense ratios of around 0.05% annually. This is due to the fund being passively managed and aims to match the performance of its benchmark index rather than trying to outperform it. It also performs well in the bond market, having historically provided competitive returns. They've also been known to offer a more predictable stream of income and capital preservation, making it a suitable choice for a fixed income portfolio. Including it in the three-fund portfolio is a great choice as it offers you diverse exposure into the bond market while providing stability, income, and risk mitigation. When combined with the stock market, you're allowed to effectively balance the level of risk and security in your portfolio and make sure that you're left with wealth for preservation purposes. But with both security and bonds and the risk versus reward factor that you get from the stock market, our three-fund portfolio strategy is then rounded out by the international fund portion of the portfolio. For this one, we'd like to talk about the VTIAX, or the Vanguard Total International Stock Index Fund Admiral Shares. The VTIAX is a mutual fund by Vanguard that offers international stocks of over 6,000 companies worldwide. There are many reasons as to why the VTIAX is attractive to investors in their three-fund portfolio, and one of them is because you're exposed to a broad range of international equities. It's considered for inclusion for diversified portfolios because it aims to track the FTSE Global All Cap ex-US Index. By investing in the international market, you're provided exposure to different countries with different sectors. You're mitigating the risk involved in your investments because economies function differently in other countries, and you're not limited to investing in just one country as a result. Different markets may experience different economic cycles. Because of this, the local and international stocks may vary in correlation depending on the region. In addition to the diversification offered, they also offer a lower cost in their fees. With an expense ratio of 0.11%, since you're compounding your investments, this can add up over time for a lot of value and taxes saved. And along with the other funds in this portfolio, the VTIAX is also a passively managed fund with exposure to international markets in hopes of capitalizing on growth opportunities outside of the US. Another thing about the VTIAX to take note of is that historically, it has had competitive results over the years. That said, in all three funds in this portfolio, one of the most important things to consider is the allocation. If you're comfortable with taking more risk, perhaps investing more in stocks would be preferable. Most people in their wealth accumulation phase tend to prefer stocks over other assets. Since you have the benefit of having a more forgiving time horizon, the risks of losing your money in the short term is negated by having more time to recuperate from your losses. Maybe you prefer preserving your wealth and growing slower but steadier over time. Then the bond market is perhaps perfect for you. People in the wealth preservation phase are typically more defensive in their investment style because by that time, you don't have the benefit of time being on your side. Regardless of how you allocate your funds, the main points of the three-fund portfolio are its ease of access, passive income potential, simplicity, and diversification. If you enjoyed this video and found us helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we'll hope to have you in our next video. Stay mentally healthy, and let's get financially fit together.